Hello and welcome. Myself Mr. Abhishek Rana, and you are watching EC1. In the today's session of EC1, we will learn about the monetary policy. So, first, we will learn about the monetary policy. The question arises, who makes the monetary policy? The Reserve Bank of India, that is also the Central Bank of India, makes the monetary policy. And what is monetary policy? The monetary policy is the policy which is maintained by the Central Bank of India to achieve some specified goals in the RBI Act 1934 or the Reserve Bank of India Act 1934 by using some monetary instruments available to it. Now, the question arises, what are the goals of the monetary policy that a central bank or the monetary policy committee needs to achieve? The primary goal of the monetary policy is to maintain the price stability while keeping in mind the objective of growth of the economy, and also to provide a statutory basis for the implementation of the flexible inflation targeting framework. And what it is the consumer price index inflation. For the Indian context, it is 4% with the upper limit of 6% and with the lower limit of 2% of the consumer price index inflation. If the consumer price index inflation is more than 6% and lower than 2% for the 3 quarter consecutively, then it is assumed that or the it is assumed as the failure of the inflation target rate. Now we will talk about the framework. The aim of the monetary policy is setting the policy repo rate and also the management of the liquidity on the day-to-day basis, and also the revision of the operating framework, whether it is working fine-tuned or not on the monetary policy stance or because now we'll talk about the monetary policy process. This is not relevant. If you want to read about the process, then you can pause the slide and can learn about the process. Now, the important part that comes about the monetary policy is their instruments. What are the repo rate? What is the repo rate? Actually, repo rate is the fixed interest rate at which the central bank uh, provides the liquidity to the banks or the commercial banks or public banks against the collateral of government and other approved securities under the liquidity adjustment facility. Uh, Now, the second one is the reserve repo rate. Reserve repo rate is the fixed interest rate at which the reserve bank absorbs the money or the liquid from the other banks. Now, the question comes, what is the liquidity adjustment facility? Uh, uh, Liquidity adjustment facility consists of overnight as well as the term repo options progressively. The Reserve Bank has increased the proportion of liquidity injected under fine-tuning variable rate repo options of the range of tenors. The aim of the term repo is to help develop the interbank term money market, which in turn can set market-based benchmark for pricing of loans and deposits and hence improve transmission of monetary policy. So basically, liquidity adjustment facility is to develop a basic understanding or setting benchmark for the interbank term money market or the interbank term money market working. Now, again comes the next one comes the marginal standing facility. What is the marginal standing facility? Uh, it is the facility provided by the central bank by which the commercial banks can borrow additional amount of money if they need from the reserve bank by dipping into their statutory liquidity ratio portfolio up to a limit at a penal rate of interest. Next one is the corridor, and the next one then the corridor is bank rate. What is the bank rate? The bank rate is the very interesting rate at which the Reserve Bank is ready to buy and rediscount the bills of exchange or other commercial papers which are availed by the central bank. Now, The cash reserve ratio is the amount of money that a bank or a central or the bank is set to maintain, or the average daily balance. Cash reserve ratio is the average money or the average daily balance that a bank is required to maintain with the Reserve Bank as a share of such percent of its net demand and the time liabilities. And the next one is the statutory liquidity ratio. What is this ratio? It is the share of the net demand and time liabilities that a bank is required to maintain in safe and liquid assets, that is the in the form of the securities, cash, and the gold. And the next one is the open market operations. What are the open market operations? The open market operations are the purchase and the sales of the government securities. And the next one is the market stabilization scheme. What is these schemes? Actually, these are the instrument for the monetary management in the market. Now the next one is the open and the transparent monetary policy making. This is not relevant. If you want to read about the making of the monetary policy, then you can learn from this slide. That's it for now. Thank you so much for watching this. Have a great day.